This is an overview of Chapter 15 from the handout that we talked about. Corporate formation and filing requirements. Corporations are separate legal entities under the law, and if a corporation has less than $5 million in receipts, or if inventory is not material, then they can use the cash basis of accounting. Corporations are not limited to a calendar year. They can choose any fiscal year in the first year of operations, and they must file a Form 1120, which we'll do practice with this. Tax returns are due in 2.5 months after the fiscal year, and corporations can obtain an automatic 6-month extension. So now we're talking again about basis, but this is the basis in the formation of a corporation. On formation of a corporation, transferors are exchanging cash and or property for stock. Generally, on corporate formations, no gain is recognized by the transferor if immediately after the transfer, the transferors control 80% or more of the corporation. Two cases in which a gain may be recognized by the transferors is if the shareholder contributes an asset that is subject to a liability and the relief of the liability is greater than the basis. Example, we have a property with a basis of $80,000 and a mortgage of $100,000 transferred into the corporation, then they're taking a relief of the mortgage that's worth more than the basis. And the second one is if boot received triggers gain equal to the lesser of the boot received or the gain. So basis of contributed property to the corporation, inside basis, is equal to the outside basis in the hands of the shareholder plus any gain recognized by the shareholder. Outside basis, or the basis to the stockholder, is equal to the basis of the property contributed plus any gain recognized minus any boot received. Boot includes any relief of liability. Unless the shareholder increases or decreases his or her proportionate ownership, generally outside basis for a corporation does not change. When forming a corporation, if the transferor controls at least 80% of the corporate entity, then the formation is generally tax-free. True or false? True. The basis to the corporation of the property received is equal to the basis of the shareholder plus any gain recognized by the shareholder. Arturo contributed land with a fair market value of $100,000 and a basis to $40,000 to a newly formed corporation in exchange for 90% of the stock. His basis is $40,000, or the basis before. When we're talking about taxable income and tax liability, determination of taxable income generally follows the same rules as a business or trade, but for corporations, the notion of AGI does not exist. Okay, capital gains. Capital gains and losses are netted together. Net capital losses are not permitted. If a corporation has a net capital loss, it can be carried back 3 years and then forward 5 years, and it can only offset net capital gains in the carry back, carry forward periods. Capital gains happen when we own a long-term asset and we sell it, or we own stock and we sell it. So if the corporation owns a long-term asset or owns stock, it would be a capital gain, as long as it was over a year. Short-term capital gains is you held the asset for less than a year. Net capital gains are included in income are taxed as ordinary rates. Charitable contributions are limited to 10% of income before charity contributions, DRDs, and carrybacks. Excess is carried forward for 5 years. So if you can't carry charitable contributions backwards, you can only carry it forward 5 years. Contribution amount for ordinary income property such as inventory is limited to the basis. Now we're talking about corporations receiving DRDs, or dividends received deduction, from other domestic corporations. The point is that corporations are your ownership in a corporation is considered double taxation, because the corporation is taxed at the corporate level and then the shareholder is taxed at the dividends as dividends are distributed, or the money is distributed, so it's taxed twice. If corporation owns another corporation, then technically that money would be taxed at the corporate level, and then taxed again at the corporate level, and then taxed at the dividend. So that would create a third layer of taxation. So in order to avoid this, they allow people who have dividends from domestic corporations who have dividends from domestic corporations to receive a DRD deduction, a dividends received deduction. It's equal to is 70% if ownership is less than 20% in the corporation, 80% if ownership is greater than 20 and less than 80, and 100% if the ownership is 80% or over 80%. And DRDs may be limited. When we talk about organizational expenses and startups, they can be amortized and deducted over 180 months, which is basically 15 years. So the corporation must make an affirmative action, and some organizational expenses or startup expenses may be immediately deductible. Taxable income is subject to tax rates of up to 35%. The tax rate schedule is progressive, but the benefit of the lower rate for the lower income is recaptured as tax income increases. We'll do examples of this. Also, corporations must make estimated payments. Payment is lesser of 100% of tax due for the year, or 100% of tax due for the prior year. Estimated payments are due on the 15th day of the 4th, 6th, 9th, and 12th month of the fiscal year for the corporation. Underpayment penalties apply if this is not sufficient. If a corporation has a net operating loss, also called an NOL, it can be carried back 2 years and then carried forward 20 years. If a corporation makes the irrevocable affirmative election to carry only forward, then they can't go back at all, and they can't change their election. Yeah, corporations do not follow the same tax rules as capital gains as individuals do. And a tax liability for a corporation, we'll do this later. Corporations have earnings and profits, E&P, similar to, but not identical to, retained earnings. E&P is based on tax law, not accounting rules. Distributions of cash or property from E&P are dividends, taxable to the shareholder, not deductible by the corporation. Again, the creation of double taxation. Distributions in excess of earnings and profit are non-taxable to the shareholder to the extent the shareholder's basis in the stock. Capital gains to the extent that the distribution exceeds the basis. So it won't be taxable as long as you have basis, but if you don't have any more basis left, then it's a capital gain. Distribution of property with fair market value in excess of basis. The corporation reports a gain or right up to fair market value. The amount of the distribution to the shareholder is based on fair market value. Distributions in a full liquidation. We'll cover this later. In this chapter we're going to just cover the general understanding, but corporations file a Schedule L, M1, and M2, and they're all on page 5 of the 1120. Small corporations are not required to complete this schedule. A Schedule L is the beginning and ending balance sheet reported in accordance with financial accounting method of the corporation. A Schedule M1 is to reconcile from book income to taxable income, not the other way around. A Schedule M1 sets forth all book to tax differences for the year, whether they are permanent or temporary. So some things that would be adjusted from book income to taxable income, added back, quote unquote. So these are pluses to book income. Income tax expense per books, excess capital losses, disallowed current year charitable contribution, book depreciation in excess of tax depreciation, because book and tax are not always the same for depreciation, and 50% of travel and entertainment expense. Remember, you can only deduct for tax purposes 50% of travel and entertainment, but on the book income you would have deducted 100%. Some things that are subtracted from book income to get to taxable income. Life insurance proceeds, this is not taxable. Tax-exempt interest, also not taxable. Tax depreciation in excess of book. So if you can actually take more tax depreciation than you can book, then you would subtract that from the income. And charitable contributions that exceed 10% of the limit in the prior year. So this is carry forwards on charitable contributions. And M3 is a comprehensive book to tax reconciliation for large corporations with assets of more than $10 million. A Schedule L is not required for small corporations. Schedule M1 reconciles book income to taxable income, and a corporation depreciation expense is lower on the financial statements than it is on the tax return. Would it be positive or negative on the M1? And the answer is negative. When there are parent or parent subsidiary groups, a common parent owns directly or indirectly at least 80% or more of one of the corporations. They can elect to file a consolidated return. If this is elected, the election is irrevocable for all future tax years. Then we have what are called brother-sister group, where 5 or fewer persons who own 2 or more corporations. Total ownership test: group owns at least 80% of the voting shares. Common ownership test: the group has common identical owners of at least 50% of the share value. If you have a brother-sister group, they must disclose this to the IRS. We are going to cover AMT on a different chapter, and we'll also cover S corporations in a different chapter. So this is the overview for the corporation taxable income.